right. Hello, everyone. Happy Monday. Welcome to Derrick Oldensmith. We haven't had Derrick on here before, but we're bringing Derrick in on our weekly live streams here for T3 Live to talk about all the things happening in the market. So, Derrick, thanks so much for joining me for this today, and we'll continue doing it in the future. How's your trading going so far today, Derrick?
It's okay. Making a few bucks, losing a few bucks. Overall, my P&L is flattish on the day to day, but that's after having a monster Thursday and Friday last week. So this is actually just fine with me. You would almost expect sometimes after a couple really big days, especially if you've got a lot of swing positions on, that there's some ebb and flow to the P&L. So after a couple really big days, sometimes you see a little bit of a pullback, almost like a P&L high or low, and then you can get continuation. So the fact that I'm been bouncing back and forth between down small and up a little bit today is just fine with me.
All right. Before we get into more market discussion, let's go through the disclosures. Derrick Oldensmith is, of course, or you might not know, but we're introducing Derrick Oldensmith. He is a professional trader with T3 Trading Group and runs the Pro Desk virtual trading floor on the T3 Live side. And here's a look at his current positions in the market. So you can see all of his longs, all of his shorts, and anything that he has closed out for the day. These are just required disclosures here for us for Derrick, as he is a registered professional trader. All right, Derrick, so before we get into the current market discussion, I do want you to kind of introduce yourself for the audience, who you are as a trader, just kind of really quick Cliff Notes versions, who you are as a trader, what your role is with T3 Trading Group, and also T3 Live.
Sure. So my name is Derrick Oldensmith. I'm a senior trader and director of business development at T3. I've been with T3 since 2010, so the vast majority of my career has been here. I started with T3 Trading Group originally in 2010 as a entry-level equity trader. 2013 had the opportunity to start my own trading desk at our downtown New York City office. So I've been working with and managing other professional traders in addition to my own trading for over 10 years. I've been able to develop that from initially a group of me and just a couple other people to what is now T3's largest group of professional traders. So working with over 100 people on a day-to-day basis at this point. It's a really large group, really good diverse backgrounds on the team. So I'm a trader first and foremost. I'm managing 29 positions right now as we're having this conversation. But I also manage other traders. I do work for T3 Live, which is T3's education and media company. But my primary role is really on the professional proprietary trading side. It is onboarding traders into the company, and it is helping to develop their trading throughout their career. So that's what I do. And again, I'm a trader first and foremost, which I just love. So.
I think that's the best part of all of our contributors here at T3 Live. We're not just talking to guys who opine about the market and aren't really in the action every single day. Derrick and everyone else, these are real traders who are in the action. He might have to manage a position here while we're talking, and that's okay, because we know that you're really walking the walk, not just talking the talk. Okay, so let's get into our topics for the day today. The title of this is Trading Earnings Like a Pro. So I just want to get, your earnings season strategy, as Q2 earnings season is really starting to pick up really this week. We had the big banks kick things off, of course, last Friday, JP Morgan Chase, Citi, Wells Fargo. I think those are the three, right? Reminder for anyone who's with us also live, anywhere you're live, YouTube, Twitter, whatever, submit questions for Derrick as they come up and we'll be sure to get to them. But here's kind of a look at this week's earnings schedule. So today we had more banks this morning, Goldman Sachs and BlackRock. Tomorrow we'll still get more banks, Bank of America, Morgan Stanley, United Health Group, the biggest insurer in the US. And Wednesday, Johnson & Johnson, United Airlines. And then the big day, I think, of the week overall is definitely Thursday with Netflix as our first tech stock reporting earnings. So talk about your strategy for this earnings season in particular, especially with the background of what's currently happening in the market, and then any earnings that you're focusing on yourself this upcoming week.
Sure. So earnings season always starts slow. It always starts with the big banks, and I'd never have felt that the big banks are a good sign of what the rest of the companies are going to do when they actually begin to report. They're kind of a little bit in their own universe. With that said, one of the big things I like to pay attention to throughout an earnings season is just how companies are overall reacting to their reports. I think a common way of thinking for people who are new to markets or haven't really traded professionally before is stock beats on earnings, therefore the stock goes higher, stock misses on earnings, therefore the stock goes down. It's not always that straightforward. That is certainly the more common situation. It's going to tend to be that if a stock beats on earnings, especially if it guides higher, that it will move higher. But that's not always the case. A lot of the movement of a stock on an earnings report is dictated not just by what the report looks like, but also where and how that stock is trading into the actual report itself. If a stock has just gone up a ton into an earnings report, that means that the expectations for that stock might be well beyond just beating. So if you end up having an earnings report that's pretty much broadly in line, but the stock has gone up a ton into that report, a lot of times you might see that stock decline. Or even if the stock beats, but it was up a ton into the report, you might sometimes see that stock decline. So it's not always as straightforward as just, hey, the company beat on earnings, so therefore the stock is moving higher. It's definitely a little bit more nuanced than that. And that's one of the big things I want to pay attention to as we get into this earnings season is where are these stocks trading compared to where they were after they last reported a quarter ago? Are they up a ton? Are they down a ton? And how are the reactions to the earnings reports? And so far, the few banks that have reported on Friday, we got JP Morgan, Wells Fargo, Citi. Today we had Goldman and BlackRock. So far, the few companies that we have seen report, the initial reactions haven't been fantastic. On Friday, I thought that the Citi report was decent, and they announced, I think, an additional buyback. The JP Morgan report seemed decent as well, and that the Wells Fargo report wasn't quite as good. Yet you saw JP Morgan just have a lot of volatility and not really do anything on Friday. It's actually catching a decent bid today, though. Citi opened up green, and they sold it all the way down to red. It's usually not a reaction that you want to see, especially on a decent earnings report. And Wells Fargo, which I didn't think was good, gapped down pretty big and got bought up a little bit. Then we had Goldman come out this morning. I thought that the Goldman report looked great. They beat on every metric that I saw. They beat on their earnings, their revenue, their guidance. I think they beat on like the net interest income number, which has become a really important number for these companies. There was good commentary out of the CEO or the CFO, I forget exactly, on the earnings call that they've got a really big backlog for their investment banking business. And with all of that positivity, I'm looking at Goldman up 1% right now when the market is trading decent and is positive. And it was with a lot of volatility. It was green off the open. It broke the opening low and went down to being red. So I'm not seeing anything exciting in these earnings reports so far. The price action hasn't been great in them. And it is what it is. Like I said, the beginning of earnings season with the banks tends to not be the most important part. We got to build into it a little bit. And then usually a couple of weeks into earnings season is when you begin to see the Magnificent Seven and those companies begin to report, which is really when the fireworks kind of begin to happen. So we'll see how it builds in. As far as myself for trading earnings names, might be a little bit boring in my approach because I don't tend to take a lot of bets going into the reports. Every once in a while, I'll now consider gambling with options into a report, but I genuinely think that that's gambling. I think that if you are, buying or selling stock into an earnings report, you are fully gambling. And once in a while, it can be fun to do it with an options contract because you know exactly how much you'll lose if you're wrong, just to see if your hunch on which way the stock is going to move on the report is right. But I do, circling back to the concept that I just described about how a lot of times when stocks have big moves higher into an earnings report, the report has to be stellar in order for the stock to move up, and it can almost be easier for it to go down. The opposite's also true. If stock's really beaten up into an earnings report, sometimes just an okay report and the stock moves higher, I'll tend to, if I'm going to take some of those gambles, I'll tend to just look at, well, what has the performance been into this report? Are people having very lofty expectations for this earnings report? And if so, maybe I'll come in on the opposite side. I would maybe be this general statement. I would be more considering buying some puts into an earnings report for a stock that went up a lot into the report. I'd be more interested in potentially buying calls into a stock that's down a ton into the report. Though it's certainly on a case-by-case basis. Where I do most of my trading is actually after the report happens, when the numbers are coming out and I can actually watch the price action as it's occurring. So instead of betting on something that I have no idea what will actually happen or what the numbers will actually be, I can trade the reaction to those numbers with keeping those numbers in mind.
We have a good actually question from YouTube in relation to that, so I want to address that. Kevin asked, for something like Goldman Sachs, do you think it's worthwhile to look at it on day two? Banks don't always move as much, but they may move the following day, or do you ignore day twos for certain sectors completely?
Sure. So it depends on the day one reaction. So a lot of the times, the best day to trade an earnings report will be the day that the company reported, because that's when the really big move happens. And then a lot of the times I actually don't want to trade it on day two, because you had this really big breakout on day one. The stock went up an absolute ton, and now it's extended on the chart. The setup's not there anymore. So you need the stock to kind of heal that extension over time, move sideways, build out a bull flag, give a technical pullback, something like that. So most of the time, I actually don't like trading day twos, especially if the day one was a very big move. The exception to that, and I think this is what Kevin is asking about when it comes to Goldman, the exception to that is if the day one move actually isn't that big. If the day one move isn't that big, so I think a better example might be JP Morgan. So JP Morgan on Friday.
I do want to tell you, Derrick, if you have any charts you want to show, like while you're talking about this, we can. Okay. We can screen share charts, etc. We can work through getting it set up together here live. It's all good. But if you need my help, it's present share screen. Yeah.
Whoa.
Because charts, of course, are always helpful.
I can click a window here. Entire screen. Here we go. Boom. Is that working?
Perfect. All right. Yep, I'll pull it up for you. There you go. Perfect. Great.
Cool. So I was just talking about this JP Morgan daily chart right here. So this might be the exception. So a lot of times if a stock has a really big move on day one, I'm trying to think of something that had a recent really big day one move on earnings, but earnings season is just starting, so they might not be out there. Yeah, that fast isn't that good of an example, so I don't really have anything. But if it gets a really big move on that day one, like let's say on day one, JP Morgan was up at, it opened at 215 and it went to 219 during the day. That green bar is just going to be in the stratosphere. It's going to be outside of all recent levels, and then the stock is going to be really extended away from its 8 and 21 EMA, which is the space that I consider to be the equilibrium area. On the day of the earnings report, when it gives that move from 215 to 219, there's probably a lot of day trading opportunity. The stock is in play. It's something that you can focus on, something you can be involved in. But then the day two comes, and now I'm just looking at a stock that's not in play on the earnings report in the same way anymore, and it's super extended. So if you still have a swing trade on from day one and you can get day two follow through, that's going to be your best case scenario. But if you weren't involved in day one, when it went from 215 to 219, and now you're trading the day two, you're asking for a worse risk reward and lower probability of success on your trading. So I want to avoid that. The exception, like I was trying to say a minute ago, is if the stock actually didn't do anything on day one. And JP Morgan, I think, is a good example of that. I thought that the JP Morgan earnings report on Friday was good. Not knock your socks off excellent, but it was pretty good. And, I was scratching my head a little bit on Friday, but I was focused on trading other things about why the stock was negative on a good report. But look what JP Morgan has done this year. I mean, the stock has had a fantastic move. I think that this was the last earnings report back here in April. So even from the last earnings report, it's gone from $180 to $208 into the report. So like I'm saying, sometimes these stocks, they're just up a ton into the report. The expectations are too lofty. You report a decent report, and the stock does nothing, or it sells down a little bit. So this action was sloppy. But today you actually could have traded it because the stock did nothing on day one, the daily chart levels are still all intact. So you can see that there's a little daily chart breakout zone between like 208 quarter and like 210. So today, maybe off the open, and it really wasn't on my radar, but maybe off the open today, you're looking at like that 208 quarter or so to see if this thing can break through the level. And it gave a decent opening move. Unfortunately, it broke the opening low here. So any long momentum traders might have gotten shaken out at 9:55 a.m. when it broke that opening low before this kind of secondary uptrend came into play. But that's what I mean. Most of the time, day two, I don't want to trade it. Once in a while, because the stock did nothing on day one, then maybe that day two becomes a little bit more tradable.
Great insight. Okay, so just a reminder for anyone else who live with us on Twitter, YouTube, LinkedIn, Facebook, all of the places. If you have any questions, just put that in the comments and we'll address them just like we did with that. Kevin said, thanks, Derrick. Okay, let's get on to our next topic, and that is, can the small cap strength continue? So we saw a large rotation into IWM at the end of last week. You can see on this chart, this was from around 10 o'clock this morning Eastern time when I took this screen grab, but so you can see the candles of the last three sessions are far extended from far above the 21-day and the 50-day moving average. So a big rally in the IWM. If everyone remembers when we showed Derrick's positions disclosure earlier, he is shorting IWM currently. So I do want your thoughts, Derrick, on can the small cap strength continue or not?
Sure. So it should be noted that I shorted a little bit of IWM today as probably a day trade. We'll see where it closes, because don't let that deceive you. This was the move that I was looking for. I've been calling for this move to happen in the first 2 weeks of July was my call, and I was very heavily positioned for this rotation trade into the IWM, into the RSP, into a lot of the non-performing stocks. I've been talking about it for kind of weeks. The first 2 weeks of July tends to be the strongest 2 weeks of the year seasonally. A lot of new money flows into the market. It's almost like forced flows into the market in the beginning of July, just because it marks the beginning of the second half of the year. So it tends to be an extremely strong period of the year. And coming into July, where the market was in a very interesting place, because the outperformance from the NASDAQ compared to the Russell has really been extreme. The market this year has been really interesting because the S&P and the NASDAQ are up a ton. I think the S&P is up like, I don't know, 18-19% or something like that on the year. The NASDAQ's even more than that. But it's really just been 3-5 companies that have given us the entire move in the S&P and the NASDAQ. So you got the S&P before Thursday's move up, I don't know, 17-18%, but the equal weighted S&P was up like 4%. I saw another chart just this past weekend that showed that the amount of companies in the S&P that are outperforming the S&P on some sort of daily rolling basis is the worst it's ever been in history. And there's a lot of things right now going into Thursday of last week and since Thursday of last week that are like, this is the most in history, this is the most since 2001, this is the most since 2008, this is the most since 1993. All kinds of statistics are being updated by this price action. And it started with just a historic outperformance from the NASDAQ and historically poor breadth. There were just no companies participating in this rally outside of a handful of names. And, you know, the thing that I've learned about trading, and this applies in a lot of different forms and markets, is that, you know, to some degree, trading is a little bit like a rubber band. It gets stretched and stretched and stretched and stretched, and at some point there has to be some degree of mean reversion when moves become very extreme. Most of the time, though, 90-95% of the time, what you're best off doing as a trader is just doing what's currently happening in the market. For most of this calendar year, of 2024, the best thing that you could have done is just continue to buy Apple and Nvidia. Just keep buying Nvidia, just keep buying semis, just keep buying the Mag 7, and ignore all the other 450 companies that are out there that have just been complete garbage and haven't moved. When it pays to be like more of a counter trend trader, or someone who wants to do the opposite of consensus, really starts to come in at moments and periods of extremes. And the hard part is really the timing, because the thing that I've learned about trading in markets is that extremes can become more extreme. Things that are stretched can become more stretched. You think that rubber band can't pull any further, and they find a few extra inches to pull it further. But you want to start taking notice when things become kind of historically extreme, and that's really where we were as we were coming into July. So coming into July, things were becoming historically extreme, and all this new money should be flowing into the market. So I actually, at that point, finally wanted to take more of a counter view and say, hey, I think that we actually might be able to see in these first 2 weeks more money flow into the Russell, into the RSP, into the companies that haven't performed, and maybe some money begin to come out of the Nvidias of the world. I was wrong for the first week and a half. Obviously, the first week there was the 4th of July week, so it was a shortened holiday week. I was on vacation anyway, so I didn't have to deal with too much pain. And then last week started the same way. And then finally, what we really needed was a catalyst to set things off. And that catalyst was the CPI. Now, CPI came in light on Thursday, and that was the catalyst for this now insane outperformance from the IWM. I think that the spread between the performance on the IWM on Thursday compared to the Qs was almost 6%. And I think that was the biggest it's ever been since the tech bubble imploded in 2001. But that's exactly what we were looking for. And what we also were considering, and this really came more from our friend Charlie at Nomura than it did for me, was that if the IWM can actually break out, it could be a situation of like spot up, vol up, where just momentum continues to come in, and that move could just be really extreme to the upside. That's exactly what we were looking for. It's exactly what we got. We needed a catalyst to get there. The interesting thing about markets is that I didn't necessarily think that the CPI on Thursday was too special. It obviously came in light. And the CPI that comes in light is going to be better for small caps and for mid caps than it will be for Apple and Microsoft, who really don't give a damn what interest rates are actually doing. But the move in treasuries didn't really bring us to any places. And I can share my screen again. We can look at the TLT. Is my screen still up? Oh, cool. The move in interest rates on Thursday, was a big move. You can look at the TLT move higher here, but it didn't really bring us higher than anywhere we were in June. I don't think that there was anything particularly special about it, though people are saying it was the interest rates. It was the interest rates because CPI came in light. I just think that it was a combination of a catalyst, which did affect interest rates, which does impact the IWM, combined with the fact that rubber band had just reached that point where it was so stretched that it just was ready to snap back, and a catalyst was needed to start the process of the snapback. And then we got it on Thursday. And, again, that's what I was positioning myself for. So Thursday, Friday last week were, two of the biggest days I've had of the entire calendar year this year. It was just a phenomenal move in the IWM. And interestingly enough, the QQQ gave like a negative Maribozu engulfing candle that day, which we said isn't necessarily the end of the world, because under the surface, everything still looks really fine and healthy, because it's just money rotation going into other things. It's never anything that's necessarily bad. So that's the move that we were looking for. Now, finally here, we're on a day 3 for the IWM. And, the Russell at this point, it's off highs intraday today, but it's trading at like 217. The 80 MA on the daily chart, which is what I like to look at again as the equilibrium zone for a stock, is trading at 208 and change. So, I've got $8+ of extension away from the 80 MA on the IWM on the daily chart. That's an area for the Russell that I would consider to be what I call extreme extension. And into extreme extension, you don't really want to be buying anymore. And if anything, you want to be booking profit on those longs and potentially putting some shorts on to hedge yourself a little bit. So that's why I'm short the IWM today. It's just, it's a day 3. We're at extreme extension here for the IWM. But even as I have shorted a little bit today, I made sure to tell the team in the morning that, and I'm trading here a little bit, which is why you're seeing my charts move. I made sure to tell the team this morning to be aware of the dynamic that we had discussed for when and if the IWM breaks out. That you could see like a spot up, vol up situation, that rotation, there's so much underperformance from the IWM that, again, going back to the rubber band analogy, when you're at $8+ of extension away from the 80 MA on the daily chart in the IWM, it's typically the spot where that rubber band is about maximum stretched and you need that pullback. But this could be one of those situations where you think that you're as stretched and as extended in the Russell as you probably can get, but there's so much underperformance here and so much potential for rotation that this could become even more and more and more extreme. So for me, my IWM short right now is relatively small. It's something that I'm building into just because of the degree of extension that we have. But without a doubt, the $10 million question right now is, to what degree can this rotation actually continue? And I don't know the answer to that. I am expecting more, but I'm running into broader market concerns as we get into August that the market itself could enter a period of more seasonal weakness, which is what we tend to always see into major presidential elections. Is starting in August through November, you get a weaker period of time for the market because market participants get a little bit more nervous. They want to have a lot more hedges on. They're not going to put money to work in the same way. So I am continuing to, for the moment, look for outperformance and continuation from the IWM and from the Russell, with a big asterisk in there that I've got some broader concern on the overall market as we begin to get into that August, September period in front of the election, where if they start to sell everything, then obviously you're not going to get really a ton of continuation from the IWM anyway. Mm-hmm. And then the other interesting part will just be, in a market sell-off, do they specifically go after selling the Apples and Nvidias, because that's where most people have their money parked at this point, in which case maybe the IWM actually holds in better? Or does this actually become a situation that we haven't seen in a long time, where correlations begin to increase and they sell everything all at once, all together, in kind of a downward fashion? We haven't seen correlations increase in a while. The market's been really interesting as far as the amount of dispersion that's out there and the outperformers versus the underperformers. And I want to turn it back to you, but just one other thing to mention, which has been really unique in this market. For like the last month and a half, I've seen something I've almost never seen before with how the IWM and the Qs are trading. Usually markets trade together in some fashion. If the NASDAQ's moving higher, the S&P is moving higher, the Russell's moving higher, they're all moving higher. You might have relative strength somewhere. Maybe the NASDAQ's outperforming a little bit, or the Russell's outperforming a little bit. The last month and a half, the Qs and the IWM have almost been trading opposite to one another. And you can break that down to as small as a 5-minute chart. There's been a ton of time over the course of the last month and a half where I'm looking at my 5-minute charts intraday and seeing the Qs uptick and the IWM downtick, and then the IWM upticks and the Qs downtick. It's a very unique market environment that we've found ourselves in for this last month or so. I think maybe that's beginning to unwind with the breakout in the IWM that we're seeing right now, but we'll see.
So you talk about the CPI being, a catalyst for that move, and the IWM, it was also a catalyst to really solidify expectations for a rate cut in September. I think that is interesting. You talk about seasonally before the election, August, September, October kind of tend to be kind of muted, but we might be having this market catalyst of a possible rate cut in September, mid-September. Do you think that would change the environment, the typical pre-election environment, with that kind of wrinkle?
No, I don't actually. And my concern is becoming that the first rate cut's actually going to be a sell the event rate cut, which I think historically that's what happens anyway. Is the first cut in a loosening cycle is actually something that's sold. With that said, this loosening period that we're probably going into now is going to be unique from any other in history, because I mean, when else has there ever been a time where we have started to cut interest rates with the stock market at all-time highs and us not in a recession? But I don't think it's going to matter. I don't think that one cut is going to be the biggest difference in the world, which, by the way, it's already fully priced into the market. So I don't think it's going to matter that much. If anything, maybe you see that, quick pop as everyone gets excited that we finally have a cut, and maybe it gets sold into. If the market's already kind of breaking lower a little bit by that point into the election, I don't think that a 25 basis point cut in September is going to change really anything from a market perspective. And if anything, could be something that just gets sold into.
Yeah. All right, I could totally see the same. All right, let's talk about something that took effect today in the market, and that was Broadcom's stock split. So the stock started trading on a split adjusted basis today. This is a chip maker, that's been on quite a run with, the NVIDIA, AMDs, all of those. Are you trading Broadcom? Do you have any thoughts on the stock split? Any trades that you're paying attention to, specific entry points, etc.?
No, I don't have a position in it. I'm not trading it today. It's tended to not be a name that I traded very often to begin with, just because the stock was so expensive. I don't like trading high-priced stocks, just because the spreads tend to be very wide. I find them difficult to trade. I don't like trading wide spreads. So I haven't traded AVGO very much recently to begin with, and I'm not trading it today. I don't think that the split matters, would be the first thing that I would say. I really don't think that the split matters. I said the same thing going into the NVIDIA split. There were so many talking heads out there that were talking about, oh, the NVIDIA split's going to be this big sell the news event or whatever. It doesn't matter. It doesn't change anything to the stock. If anything, historically, and this has also changed, historically, splits would be good for companies because they could bring in new investors. If you had a $4,000 stock, just to make up a random expensive number, and you're just a regular mom and pop investor, you might not be able to afford a single share of that $4,000 stock. So you go buy something that's trading at a cheaper sales price because you can diversify your portfolio. You can take that $4,000 and buy 10 companies instead of buying one share in one stock. That's changed because a lot of retail brokerages now can do like the partial shares. So if you've got this really expensive $4,000 stock, you want to be involved in it. You don't want to buy, one share for $4,000. You could buy like a tenth of a share. That exists in brokerages now. So it's taken away, I think, the impetus for there to be new buying that comes in after a split. But I also didn't think that NVIDIA was just going to be this, sell the split, sell the event situation, because it doesn't matter. It doesn't matter. It's trading at the exact same price that it was trading at on Friday. They just did a split. So I honestly don't follow AVGO even close enough to know what the exact split number was. I really don't know. But if it was a 10-to-1 split, you got stock from the exact same price. You just got 10 times more. It's the same dollar amount, right? So it makes no difference. The technicals on AVGO today, they look very sloppy. Nothing happened. It tried to break yesterday's high and move higher. They sold that move back down. I think it's a non-event. It's not worth mentioning.
All right. Last call for questions for anyone who's with us live. If there's something specific you want Derrick to discuss, go ahead and submit comment. Whatever platform you're on, post a comment. We'll see it here. All right, here's a look ahead at this week. This is the economic calendar, kind of what the market is paying attention to. We got the Empire State Manufacturing Index this morning. Powell is speaking, I think, right now, or just spoke about 30 minutes ago. Tomorrow, we'll get retail sales, import prices, home builder sentiment. Wednesday, housing starts, building permits, the Fed Beige Book. And then Thursday, your weekly jobless claims as usual, the Philly Fed Manufacturing Survey, and the leading economic indicators. So last week, the big catalyst for the market was that lighter than expected CPI that triggered that rotation into the small caps versus the mega caps. Anything on this list that you see as a possible catalyst this week? Anything you're paying attention to on this calendar for yourself?
there's nothing here that's nearly as important as what happened last week.
Hmm.
Retail sales should have some importance. The jobless number should have some importance, but they're not going to be overwhelmingly significant situations, I don't think. Right now, we're in a period of time where we're moving from the macro being really important because we're in between earnings season to the micro becoming really important. So what's about to matter most for the market, I think, in a lot of ways, in the short run, is going to be earnings reports. And now that we're past the CPI, there's not going to be too much going on there until we get the next, Fed event, and eventually we'll get the July CPI in the beginning of August. That'll be important, but we're still a ways away from that.
Another interesting question from Kevin on YouTube. He asked, looking where SPY and the Qs opened, how surprised are you at how well the market held after this weekend's presidential activities? I was overly cautious for a sell the news event.
I'm not surprised at all to see the market trading higher. The only thing that made me a little bit nervous about the market was actually the move in bonds. So the TLT is down a lot, so interest rates are up. Sometimes that can create a little bit of a drag on the market, especially the IWM. But the IWM is holding in just great. The rotation trade's continuing. It's up 1.7%. Also, the dollar's a little bit stronger today. So the dollar being a little bit stronger and interest rates being a little bit higher tends to sometimes weigh on the market a bit. We're holding in really well. I think from a market perspective, and I refuse to get into anything that is just about political opinion. From a market perspective, the important thing about what occurred over the weekend is that it improved the probability of a Trump presidency coming up. And then the question then becomes, what does a Trump presidency do to risk assets? And the answer to that we're getting from the market is bonds down, interest rates up. And that's probably because, if you're talking about a regime where you're going to continue to spend a lot of money but also cut taxes, well, you got to probably sell a lot of bonds to be able to do that. So it makes sense that the TLT is down a little bit on it, and that the dollar is a little bit also stronger as a result. And then you need to weigh those impacts and their potential impacts on the market itself. So I think that the biggest takeaway that you want to be thinking about the terrible event that happened over the weekend is, what does an increased probability of a Trump presidency do to risk assets, and not necessarily, as terrible as this event was, and there is no room for political violence in our country, in the United States, that this cannot happen. But the fact of the matter is that he came away relatively unscathed from it. And, the impact on the market is going to be vastly different with the situation that happened versus if that gunman was a few more inches to the right. We'd be looking at it probably a very different impact on how it would be affecting the market. That probably would be a more scarier sell the event news situation than the situation that we're actually seeing right now. But again, the fact of the matter is that former President Trump is just fine, and the major impact is that there's a higher probability of him becoming the president. And what are the stock market and risk asset implications of that occurring?
All right, so for everyone who has enjoyed this live stream, we do have a free ebook for you written by Derrick about prop trading. So you can go to t3live.com/DO live if you want to get that free ebook. Again, Derrick is a professional prop trader with T3 Trading Group. Derrick, go ahead and just talk about, just real quickly as we wrap things up here, what it's like to be a prop trader with T3 Trading Group, and kind of maybe what the qualifications are for someone who is listening and might be interested.
Sure. So at T3 Trading Group, if you become a professional trader with us, you get to be involved in a community of professional traders, and we are able to provide trading in equities, options, futures, and options on futures, The equity side of our business requires licensing with an SIE and a Series 57 exam. The biggest benefit is that you get access, well, multiple benefits. You get access basically to T3's balance sheet to assist your trading, T3's team, and T3's technology. So from a balance sheet perspective, it's most straightforward on the equity side. Options and futures a little bit more nuanced. But on the equity side, we typically would provide a trader buying power at 20 times what they fund their account with for day trading and 8 times for overnight positions. And then you're compensated through a generous profit split. At the same time, you get access to our team. So our team runs through the Pro Desk virtual trading floor. It is a room that, subscribers can purchase access to, but the main goal of it is really to be a resource for the internal professional traders who are here at the company, and not necessarily for subscribers, though, if you want to be a subscriber, a paying subscriber, something we would consider. But if you become a professional trader with T3, you get access to it for free. And then you get access to our technology. So our technology, our trading softwares, our ability to build algorithms and black boxes. If you're a futures trader, you can get access to our CME and NYMEX seats. So there's a tremendous amount of benefit, I feel, in being a professional prop trader compared to being in the retail side of the business. That's why I trade prop myself. And if it's something that interests you, you can reach out to me. My email is doldensmith@t3trading.com.
All right. And again, for everyone who is still with us live, you go to t3live.com/DO live to get Derrick's free prop trading ebook. All right, Derrick, thanks so much for doing this with me today. We'll be back, everyone, next week at 12:30 p.m. Eastern next Monday. So come ready with your questions for Derrick as, the trading develops this week and we start a new week of trading a week from now. Thanks so much, Derrick. Have a great rest of your trading day.
Thanks, Greta. Thanks for having me.